Good morning. We will spend time on the effect of VAT on purchases of goods or when goods are returned to the wholesalers. The first entry is when we buy goods for 18,810. It means that this 18,810 includes the VAT of 14%. So the first entry that we will record is to determine what portion of this 18,810 is VAT and what portion is the inventory that we bought, the cost price. The total amount equals 114%. The cost price of the inventory will only be 100%. And if we want to calculate the figure, we take the 18,810, multiply with the one that we want, the 100, divide by the 114 that was given to us. So that means that the inventory cost price is 16,500. The VAT is 14 over 114, and that will give me 2,310. This 2,310 will not form part of the cost price of the inventory because this money can be claimed back from SARS. So when we record this in the ledger, we will credit our creditors control with the total amount that's owed to the creditors, and this will then be 114% account because it includes the cost price plus the VAT. The VAT account is a 14% account, and we will debit VAT input with the 2,310, and this is the amount that we can claim back from SARS. Then the inventory will be debited with the 16,500 to increase the value of our asset with the 100% excluding the VAT. The second entry that we will record is when the goods are returned to ELS 2736. So first of all, again, we must calculate of that 2736 how much is the cost price and how much is the VAT. So the 114% that we return equals 2736. The cost is 100%. So the 2736 multiplied by the one that we want, 100, divided by the 114. So the cost price of the goods returned is 2,400. The VAT will be 14 over 114, and that means the 336. Now when we bought the goods, we claimed back the 236,000. 2,310. When we return goods, it means that we can't claim back that 336 anymore, and that means that we must show that we owe the 336 to SARS again. Then we will credit our inventory account with the 2,400 of the goods that was returned because the value of our assets decreased with 2,400. And we will debit creditors control with the inventory, and we will debit creditors control with the VAT to show that the total amount that must be decreased must be 2,736. What did we learn today? When inventory is purchased, the VAT can be claimed back from SARS, although the money is still owed to the creditor. So we claim the money back immediately, although we will only pay the creditor later. The cost price of the asset, the inventory, excludes the VAT. So the inventory will never have VAT in it because we claim the VAT back from SARS. So the cost price of the inventory will always exclude VAT and will therefore be 100% account. The total amount cost plus VAT is owed to the creditor, so the creditor is 114% account. When inventory is returned to the creditor will reduce with the total amount, that is the cost price plus the VAT, and we will reduce the creditor with a full 114%. The cost price of inventory must be reduced with the cost excluding the VAT, because the inventory is accounted for at cost. So inventory will be reduced with the 100%, that is the cost price, excluding the VAT. The VAT must be paid back to SARS, because when we bought the goods, the VAT was claimed from SARS. If we return goods to the creditor, we owe this VAT to SARS again.